Welcome, everyone, to Name Confidential Live.
Hi, everybody. Welcome to Name Confidential Live. We have the pleasure of having two excellent guests today in Tim Schwister and Nick Apt. Tim is a partner at Global View Capital Advisors, where he co-developed the Snapdragon trading strategy, drawing on over a decade in wealth management and tactical portfolio design. Tim focuses on disciplined, rules-based approaches that blend technical precision with practical risk controls. His work with Snapdragon includes a proprietary Fibonacci-based energy mapping system to identify high probability entry and exit points across major markets, with both leveraged and unleveraged applications for retail and institutional investors. Nick Apt is the technical architect behind Snapdragon's analytics engine. With a background in quantitative modeling and system design, Nick specializes in translating complex market structures into actionable trading rules. He works alongside Tim to refine signal generation, validate performance, and ensure the strategy's adaptability in both calm and volatile markets. His behind-the-scenes expertise helps turn visual chart insights into precise, repeatable trades. Nick, Tim, welcome to the show.
Hi,
Thank you, Kenton. It's great to be here.
thanks for having us.
So I figure, why don't we just take a step back, tell us a little bit more about Global View, Snapdragon, a little bit of the way that you guys look at the world.
Sure. Well, to be clear, Nick and I are IARs with Global View. We're not technically partners. There's a legal thing up there, but we are partnering with Global View on this. When I first started out in this in the space, I had some questions. I was very, very interested in mapping systems and tracking things, and I had some ideas I didn't have answers to, and I started to develop this thing with Nick, and we said to Barry and Dino over at Global View, said, "Hey, we've got this thing that we really think has a lot of potential, and I want to show it to you." And they were very, very supportive, and they have been trading this in two incubator accounts. We have a leveraged and an unlevered version of this, and they've been beside us and behind us all the time. So I would consider this more of a partnership with Global View, in that we want to make sure that this is available to all Global View advisors, and we want this. We're expanding this so that it should be available to other RIAs and institutional clients as well. We're trying to keep the retail with Global View and do the institutional and the accredited on our own. So they've been incredibly helpful. I can't say enough good things about Global View. I absolutely love them.
Yeah, let's jump into it. Energy mapping, fib-based levels. How does this guide your trading practice?
Well, I think I should probably start with the idea behind it. I looked at systems in general, and separated systems and integrated systems, and I noticed that sometimes systems are stable and sometimes they're not. And I wanted to find out what causes a system to become unstable. And what I ended up creating was, I call it an energy mapping system. The idea behind it is that within the different Fibonacci levels, there's a different amount of space, right? That's how fibs work. And there has to be a minimum and a maximum that fits comfortably in that space. And once you hit the maximum level, and I don't want to get too nerdy, but the maximum level that a system can take, that's called the Hamiltonian energy value of a system. And I wanted to find that, and that's what we've achieved. And it's very nimble, it's very accurate, and no two systems are ever the same. So it's also self-correcting, which is really, really great. But those energy levels are what give us our resistance and our support. And we can look within any time frame and looking out in the future, and it allows us to predict with great accuracy where levels are likely to go. Now, market shocks and things like that might throw a wrench in the works. When that happens, we can see it, and we can move out of a trade. If we're on the wrong side, we can move out within a day, which gives us an advantage. I did notice during a couple market upsets back, during COVID and things like that, I was watching other active managers, not just global view, but all over. And a lot of the models took a while to correct and to pull out of that. They did well after things turned around, but it was getting out of the way quickly that was the issue. And our model addresses that, and it moves out of the way quickly when there's danger.
Nick,
then-
anything you want to add to that?
Yeah, and where when his first idea was identifying the important levels of where things were occurring, I went in after the fact to identify when something had occurred. So we started with finding where those levels were, and then being able to identify early when a shift was occurring and so for instance, say you have a move and looking back in time, you can say, okay, there was a nice big trend that happened for these 3 months and then it faded here. Well, when you can identifying where you can early on that a shift is occurring in direction, and then when that shift has pretty much ended itself. That's where I came in and after the fact to identify when those were beginning and ending.
Yeah. So I think this time, why don't we jump in? You have any case studies or a couple of graphs or trades to show us maybe a time that it worked? We'd love to kind of see what it looks like from your end, Tim.
Sure. Let me just pull something up real quick here for you. Can y'all see this?
Let me know
Here
when
we
you're
go.
sharing. Okay.
I think, can you see that?
Yes.
Okay. If you look here, this isn't a live chart, but if you look here, you'll see the different fib levels that we've drawn that mean different things. So if you look here at this little arrow, you'll see that we were watching this. We hit this fib level, we rejected it, we came back up through it, and it was rejected again. There's not enough volume here. There's not enough momentum here. So we said, this is a failure. We're going to pull the cash, right? So we stayed in cash until I believe we re-entered
Probably right there.
actually up above right about here. So we gave up a couple tenths of a point here, but we wanted to make sure that we were not going to go down. So we were sitting in cash. That's a built-in safety feature. This model does move to cash, and it moves to cash quite often. And usually that happens in these areas that are highlighted where we get uncertainty, instability, and consolidation. Consolidation means confusion, and we don't want to play in the same game when everybody else is confused. We'd rather take a step back. We'll move to cash or a cash equivalent, try to pick up a risk-free rate for as long as we have to do that. And then once the market signifies to us again that it is ready to go, then we go back in the direction that it is indicating we should go in. So another example.
So I'm not seeing the x-axis here. What time frame do you think we're on?
This one is this is a daily, and we're from this is November of 2024 over here. So
all right,
up
so
to current.
we're looking at the month of November. These are daily values of 2024.
Well, this is
No,
November all the way
this is all the way
through
to current.
today.
All
This
the
is
way to
to today.
today.
So this is about
Right.
the last 9 months on this chart.
The last 9 months on the chart. Okay, great. So then the orange arrow is pointing at what date?
That is on the June 11th.
Okay. So with that particular time, you had this two bands here, and it didn't hit that top band. how did you set the range of those bands? It says
The
534.83 and 528.34 on the left side of the screen on those bands.
That's the question everybody wants the answer to. That's kind of the secret sauce here. I'm a nerd, and I love physics, and I love math and trigonometry. Those are based off of quantum physics. There's a specific formula, there's a specific number, and um, there's a way to map populations of whatever you wish, whether it's dollars or how much how many marbles can fit in a jar. There are ways to map these things out. So that really is the secret sauce, is how we draw our fibs and where we get those levels. But I can tell you that it's drag and drop. It's scalable. So what you're seeing here works from, yearly, monthly, daily, down to intraday. Can get kind of hectic intraday if you're doing some day trading, but it's scalable because it's universal. That math does not ever change.
Okay.
That math
So
remains.
if we're looking at a 9-month time period of QQQ, how many of the ranges did populate? I'm just kind of looking along the right side of the graph, and it seems like maybe what, 2, 4, 6, 8, like looks like there might be 17, 18 of these ranges littered along this 9-month time period. On average, for a time period, how often do you get these ranges?
Well, I would like to actually show you. I'll here, and I'll show you live. Okay.
And
To stop sharing, and I have to reshare about this. Okay. Can you see this?
All right, we're in.
Okay. So these Fibonacci levels here, this yellow one that we're up against right now, we're literally right here. That was drawn 11/21 was the end of the fib sequence, and I started that November 2008. So we go from 2008 to 2021. And these are our fib levels here, 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 and we are currently right at it inside of these two yellow lines. So I don't
so
want to share any more of that, but
and what we'll often have too is we'll have short-term stuff where we're looking at what's going on in like the last couple of weeks. We'll have stuff that'll be, for instance, multi-year that we're looking at. Okay, this range is a range of volatility that we should keep an eye out for there to be uh, a more kind of a bias to the safety side, where other stuff is okay. This is the last quarter, pretty much. We'll be looking at the last 3 months or something like that, where that individual move for it might last 3 weeks, it might last 3 months, but a specific trend is going on, or the previous trend.
we generally need three. We generally need three movements in the market to map. We need at least one move up, at least one move down, and another of either in order to place these. So you're going to get three. We're going to get three Fibonacci sequences layered on each other. Some are going to have a big fat line because it's important because it's a 12-year trend. Some are going to, and we can use our charts to map that, but we're going to have a long, an intermediate, and a short.
So
Generally speaking, in order to find these levels.
And we always, it's always good to, understand and reflect on why things work. I think we're not always as critical as we should be when things work. We kind of assume we were right for the right reasons. We certainly get quite a bit more critical of ourselves when things don't work quite as well. Do you have an example, a recent example where things didn't work quite as well, and how things changed, or how you sort of digest that error?
Nick, did you?
Sure.
Oh, I do have. I have that. Nick
I
gave that to
can
me.
I can go ahead
I'll
and
share it. I'll share it if you want to
well, I can share the
talk about
trading
it,
view
Nick.
version, or do you want to just do the screenshot?
Uh, why don't you share? I'm
Okay.
not so great at this.
Let's current share with screen. Let's just go.
Because we always have this kind of quadrants in decision making and reflecting of how our investment in performance, of if we were right for the right reasons, or we were right for the wrong reasons, right? Things that we didn't kind of forecast, or we were wrong for the wrong reasons, or wrong for the right reasons, like, you know,
Hmm.
gotten it right, but the market direction was incorrect. Of course, it might not apply to your trading strategy, but it would be interesting to see how you guys digested a period where you're battling a drawdown.
So what often happens within the model of when things go awry is when something has fundamentally changed from a news perspective. So we are we started a new trend going in a specific direction because of basically bounces off of support, comes up, or we've had positive news lately with the market's going up, right? And then something happens to just fundamentally shift inside of the market here. So right here is what actually happened with the Japan carry trade. So when the market kind of blew up with the yen carry trade, we had initially been bouncing off of a support level, and right here we had gone long, right, in this instance. And then as the week progressed, not most people didn't really know about the Japan carry trade until the weekend, but the market had started selling off. And unless you were really paying attention to Japan, which I know I wasn't, um, the market started selling out. So we were long going into the carry trade, and then the market sold off. And this was actually the day when we um had so that
This is
August
the day we
1st we
launched.
had played the trade. Yeah, that's when we launched. We had
It
placed
was
our
the
trade in
first trade,
August.
and we were on the
And then
right side of it.
by the end the market had already been going away from us because the yen had been collapsing and all the issues revolving that. So what it comes back to is when a market abruptly shifts directions, that's really what will cause us issues due to news releases that are consequential but reversal of what's going on. So we had issues back in January when the tariff stuff was going back and forth, back and forth, back and forth, and any given day, you'd have a new piece of tariff news that was fundamentally shifting direction of the market. Things like that are where our weakest points are when something changes and then abruptly changes back.
Yep.
So in
So
this entry here, what can you highlight the three lines that you were looking to surpass in order to trigger a buy? Because if I remember
yes.
correctly.
Yes, this is it. I unfortunately I can't mark this up right now. I don't have the markup tool, but as you can see, we're watching this, and here's daily trades, and we came down, we dipped into it, and we got a clear breakout here
Mhm.
from the fib level. This is the top of the fib here. This is the bottom of the fib here.
Right.
We got a breakout right here, and there's a purple trend line. It's hard to see here. It's a very
Yeah, I
This is
see it.
very trend line, but the trend line broke right at the same place too. And this to us, to this model says go long.
Okay.
That's a long signal. So we did. And then the Japanese yen uh, carry trade problems started. And as you can see, the next day,
So
it moved down, but we didn't move out because it didn't violate. Right?
Mm.
We're still long. And then the next day it dropped straight through this fib. It didn't even touch it. It broke right through. And then we're on the wrong side.
All right.
But we can get out the next day, right? Which I think we might have we didn't ride it down very far. And we recovered from it pretty quickly. Our recovery times are very fast.
It's one of those things where we ended up long, then it flips us around, and then evacuated around. Like these herky-jerky moves, like what happened with the Japan carry trade, where it got launched down and then immediately back up. Those are things that will mess with the model.
And I was remembering in our pre-discussion that you typically have a an average hold period of what, 3 to 4 weeks? Is that correct on your longs?
Generally speaking, yes, about 3 to 4 weeks. Our shorts, unless something really strange is happening, short opportunities we're going to be 1 to 3 days. That's not a unless there's an actual extended bear run. We're not in for very long, and it's kind of hard to tell because sometimes those bearish declines, if they're real shallow, that's hard to trade. So we're probably going to be in cash for a while if that's going down. We need a really solid signal to go short.
And Tim, I remember you referring this in some way as like a gossip risk. I don't know if that's exactly your words or my interpretation of it, but sort of when the news cycle goes against you, and that, one of the hardest challenges for your model or really any model in many times is unexpected policy shifts or headlines that hit the market. Um, Maybe looking at the Japan carry trade up till today, how have you seen Snapdragon adapt in these moments? And have you built in contingency rules, or is it about quick human override?
Everything that we do here is human. We're not running an AI. This is not a Python script. This is us watching it. Um, One of the things I mentioned before is that this is self-correcting. So every time we have a trend reversal, those are new starting and stopping points for us.
Right.
So the accuracy builds with time, but we have to keep our eyes on it. I'm trying to see if I can find an example of the tariff shock that was. Does anybody remember when that was? Was that like April,
Liberation Day?
May?
That was December through February is when it was jerking around like crazy.
Okay, I was thinking the December one, but it.
So the gossip
Not really
risk.
sure how to.
I'll take a crack at it. The gossip risk is more so along the lines of that it's jerking the market around in various directions. We don't necessarily override it from like a human perspective, saying, "Hey, I'm not gonna take this trade because there is a headline attached to it." Our goal is to have it based off the numbers. What are the numbers saying that the market is going to do? The vast majority of the time, it's right, and it gives us good numbers, gives us good trades. Sometimes they obviously go against us in those situations where uh, the market the policies get backtracked real quickly, and then we're on the wrong side of the trade, and we have to back out again because the numbers do tell us that, yep, something has fundamentally changed again because we're not tariffing the Canadians 50%, whatever it be.
Hmm. Hmm. So I think that
An
probably,
unusual. I think this is a rather unusual time period that we're in. Everybody knows about changes in policy, different risks. Policy risk is always part of the markets, but it's been, I've seen a lot more jerking up and down and left and right due to policy insecurity or confusion than I think ever before. But that doesn't mean that that you can't overcome it. It's just that you can't always play it, or at least this model, the specific model, is it's going to need a day or two to get in or out, right? And that does move a lot faster than most other models, because we get to take in the short, mid, and long-term signals. And every time we look at the screen, we've got all those signals on there. But it's been difficult recently because of, I guess, this national or international art of the deal that we're going through right now. Policymakers bluff. And when they bluff, sometimes the market doesn't know it. Somebody gets rich when that happens, but it's not fun to play. But I guess our saving grace in that is that we're able to correct quickly. And those blips can be, we know where they are. So we're not drawing our future forecasts based off of a 2-day newsreel, right? 2-day news cycle or something like that. So we're,
So what's
we
the
don't like
future for
it.
you?
Pardon?
So what's the future look like for you guys? Because you've been working on a model, you've had I think you said a little bit over a year where you've been able to have this in test accounts, and you're looking at getting this out into the wild with client money. Tell us a little bit about how you put that forward, because it's going to come down to, track record and the analytics, and being able to have somebody get comfortable putting capital into the repeatability of the strategy.
Well, luckily we found this really great place that is willing to help us out and get us in front of potential clients, institutional big money. The goal is to get it into the hands of the retail clients, my neighbors, my friends, my nephews, brothers, sisters, people who are younger and just getting into their investing lives. But in order to do that, it makes more sense to start by offering it to real advisors, people who can really use it and get it out there, which is one of the reasons that we're talking with you guys, with Addigence, for that. And we're continuing to develop models. We want to know what other advisors want. Okay, we can use our tools to create different models based off of different needs. Right now, we're working on a Russell model, an R2K model. A lot of different advisors have blended R2K models and things like that, and we're looking into. I'm not saying we're going to necessarily put it out there, but we're looking into a straight up pure R2K model. We like playing gold. I know Nick likes playing gold. I've been playing uranium a little bit. So
It
I'm looking.
the nice
It's
thing is with the math, it maps over really any the vast majority of largely traded tickers you can map it over. Now, whether or not it works really well with one versus another, depends on the dynamics of that specific market. But for QQQ is one that we find that it really works well with. Gold, it works pretty well with. The Russell, it works pretty well with. But other ones where you see rapid changes that then do nothing, like TLT, I struggle with TLT sometimes because we're talking quarter points. It's always thinking the market is always thinking in point Fed moves, and that shifts rapidly. So by the time a move has been projected into the marketplace, most of that trade happens and has already happened.
So let's talk a little bit about gold. And I know we're at the top of the hour, but would love to kind of dive in. Why do you feel like gold's working more than others? And also, I think I want to preface this question is gold's been in an uptrend.
Mhm.
And I don't want to be too critical, but certainly trading something that's in an uptrend and making money in it is something that you're capturing a fair amount of a beta, perhaps. I don't want to put words in your mouth, but why is gold working?
Uh, Gold works because it, from a trading perspective, when a direction is chosen kind of by the market, if gold is going up, it goes up for a significant period of time. So if a market moves to its preferred levels very rapidly, that could be a struggle to capture. But when the time period gets drawn out of when it moves from one price level to another, you can identify the trade early and then ride that trade the entire way through. Because we're not trading in and out of it on a daily basis. We're
Mhm.
trying to identify the trend and then ride the trend. So gold will go a couple of months in an uptrend and you can just ride the whole thing.
So just the
I would
metal
I
I'm
would say in
looking
my
at here.
experience,
Go ahead, Tim.
I would say gold trades, in my experience and the way I look at it, a very similar way to crypto. For some reason, I don't have the exact answer to that, but the technical levels that gold trades at are real tight, usually, and so is crypto. Our model works very, very well when it's put over crypto. That's something we can talk about at a future podcast or something like that. So this does work in that space, but there's something more rigid there about gold and crypto. I don't know what it is. I'd love to know. But when it trades, it's tight.
So let's put some numbers on this. Gold's up 39 percent, almost 40% over the past year. How has overlaying your model outperformed the benchmark?
That we don't
Uh,
have data on.
yeah, we don't have data on that.
Yeah, I'm sorry,
We
we don't
haven't
have data
launched
on that right now.
it's one where we are experimenting with it, but we haven't launched a test model for gold yet.
We can tell you for the Qs. The Qs from the most recent data that we had, which was compiled by Barry and Dave Morton over at Global View. As of June, we were up 20 points even uh, with Snapdragon model. So, and I'm
Year to
not
date?
sure what. Yeah, year to date,
All
we're
right.
up 20 at the end of June, and we're waiting on July's numbers to come through right now.
So that's quite strong. Triple Q is up 12% year to date. 800 basis point alpha is outperforming the benchmark. So congratulations on that. That's
Thank you.
Thank
worth
you.
Thank
celebrating.
you.
So with that, let's end on a high note. I think we always like to go out with some words of wisdom. Tim, I think you prepared a quote for us.
Yes. I said I love math. I'm very visual. I love the arts. I'm pretty much basically half and half brain, but this is something that I love. And this is something this is a quote by Bertrand Russell on the study of mathematics, and he says, "Mathematics, rightly viewed, possesses not only truth, but supreme beauty and cold." But supreme beauty, cold and austere, like that of a sculpture, without appeal to any part of our weaker nature, without the gorgeous trappings of paint or music, yet sublimely pure and capable of a stern perfection, such as the only the greatest art can show. The true spirit of delight, the exaltation, the sense of being more than man, which is the touchstone of the highest excellence, is to be found in mathematics as surely as it is in poetry. I
Well,
love
I
that.
think
That's framed.
the next opportunity to combine math and excellence and poetry could be at our upcoming Name Outlook event. We are looking forward to seeing you there.
We will see you in Chicago. Yes, absolutely. Looking forward to it.